Two checkboxes on the same TFSA form. One keeps the growth tax sheltered after your spouse dies. The other doesn't. And on a six-figure account, the gap between them is real money. A TFSA is the tax-sheltered account most Canadians know by name. The part most people never check is what happens to it the day the holder dies. If you are married or common law and your spouse holds a TFSA, or you hold one yourself, this decision was made the day the account opened. It sits in one checkbox on the contract, ticked years ago, and the CRA only honors the box that was actually ticked. There is no upgrade after the fact. By the end of this, you'll know which checkbox keeps the shelter alive, what your spouse has to do within 30 days if the other box was ticked, and the one Quebec twist. Here is the order. The successor holder shelter is the piece that breaks the most, because the language on the contract makes it look like a sub-option when it is actually the path. The exempt period and Form RC240 are the rules no one explains. With a 30-day deadline, most channels get wrong. The Robert and Margaret reveal is where the math actually changes. The same household and the same balance, one box of difference. And the common traps, including the one Quebec twist, are the moves that lock the answer in. We'll walk it with one Ontario household, the same dollar amount, the same surviving spouse, and the only thing that changes is which checkbox got ticked on the contract years ago. Same inputs, different outcomes, by one box. The first piece is the language itself. Successor holder is the CRA's word for one specific path. Your spouse or common law partner steps into your TFSA as the new owner, and the tax shelter keeps going as if nothing changed. Designated beneficiary is a different path. The person you name on the contract receives whatever is in the account on the day you die, tax-free. But the shelter ends right there. Anything earned after that day is on a different set of rules. Successor holder transfers ownership of the account itself. Designated beneficiary transfers the cash inside it. Same word on the form, two completely different events on the day someone dies. Now, here's where the CRA makes this confusing. On the contract, both options say beneficiary. Most institutions list successor holder as a sub-option underneath. So a holder who skims the paperwork ticks beneficiary, thinks that covers their spouse, and never sees the sub-option that actually preserves the shelter. The names look like the same word. The CRA treats them as two completely different paths. Successor holder keeps the shelter going. Designated beneficiary ends it on the day of death. And the choice is locked the moment the holder dies. You cannot retroactively convert one into the other. The surviving spouse cannot upgrade a beneficiary designation into a successor holder after the fact, no matter how reasonable the request sounds. The institution will follow whatever the contract said on the day of death. Whichever box was ticked then is the path everyone is now stuck with. That is the framing on paper. The reason successor holder actually keeps the shelter alive, and why it does not cost your spouse a single dollar of her own contribution room, is the next move. The second piece is where the shelter actually keeps going. When a holder names a successor holder on the TFSA contract and then dies, the surviving spouse becomes the new holder of that TFSA. The account does not close. It does not transfer. It does not get rebooted under a new number. The same account, with the same balance and the same investments, simply has a new holder's name on it, and the tax shelter continues without interruption. Two pieces of fine print matter here. First, successor holder is spouse only. That means a legal spouse or a common law partner who meets the CRA's definition. Your kids, your siblings, a friend, a parent, none of them can be your successor holder. If you name a non-spouse on that line, the institution defaults them to designated beneficiary, and the shelter ends on the day of death. Second, and this is the part most viewers miss, none of the rollover uses your surviving spouse's own contribution room. If she had 0 room left, she still receives the whole balance, sheltered, no penalty. The successor holder path does not borrow against her future contributions either. Once the account is in the survivor's name, it's hers. She holds it, she draws from it, she contributes to it on her own annual room. She names her own successor holder. The CRA treats her as the holder from that point forward, with all the same rights and limits she would have on any TFSA she had opened from scratch. That is the path that holds the shelter. The other path has its own rescue mechanism, but only if your surviving spouse files one specific form inside one specific window. And almost nobody mentions the deadline correctly. And here's the form most people get wrong. If the box ticked on the contract was designated beneficiary, not successor holder, the shelter ends on the day of death. There is still a rescue path for a surviving spouse. It runs through one CRA form and one rolling deadline. The exempt period is the CRA's window between the day someone dies and the end of the next full calendar year. So if Robert dies in May 2026, the exempt period runs through December 31st, 2027. The rollover is the popular word for the rescue. On the CRA form, it's called an exempt contribution. It lets a surviving spouse add the inherited amount to her own TFSA without using up her room. The form is Form RC240. Page 2 of the CRA's RC240 form states plainly that the surviving spouse must file the form within 30 days after the contribution is made. A lot of finance content gets this wrong. The deadline is not the April 30th tax filing date. It is 30 days from the day she actually moves the money into her own TFSA, rolling per contribution. Miss it, and the rollover does not count. The amount takes up her own contribution room, and if she didn't have room, she just over-contributed. One more piece of fine print. The exempt contribution is capped at what was in the account on the day of death. Anything earned between the day of death and the day the cash moves is outside the cap. The algorithm only pushes this to other Canadians if you engage. Likes and comments are how this stays visible. And on the Quebec twist. In Quebec, the rule is different. Quebec doesn't let you name a successor holder on the TFSA paperwork itself. The designation has to live in your will, and you'll want a notary to write it. Your spouse can still inherit, but the path runs through the estate. That is the rule. The dollar gap it produces on the same household with the same balance and the same surviving spouse is the number most people would not believe until they see it. And the final piece is the dollar amount that makes all of this real. Same household. Robert, 71, Margaret, 68, Ontario. Robert's TFSA holds about $200,000 on the day he dies. Margaret has already filled her own TFSA. Her remaining room is 0. Path A. Robert ticked successor holder. Margaret becomes the holder of that TFSA. The $200,000 stays sheltered. So does every dollar it earns from that day forward. 0 tax, 0 room used. The shelter keeps going under her name. Path B. Robert ticked designated beneficiary instead. Same household, same $200,000. Margaret receives the balance tax-free as an exempt contribution. She files Form RC240 within 30 days of moving the money. The $200,000 goes into her own TFSA without using her room. So far, the paths look the same. They are not. The shelter ended on the day Robert died. Anything the account earned between his death and the day Margaret moved the money sits outside the exempt contribution. The institution issues her a T4A slip. The post-death growth lands in box 134, the line for the taxable TFSA amount. It adds to her income that year and gets taxed at her marginal rate. According to publicly available CRA data, that tax bite varies a bit by province. On a balanced sleeve earning roughly $3,000 or $4,000 of post-death growth, in Ontario, Margaret pays about $1,500 to the CRA on Path B that she keeps entirely on Path A. Same household, same balance. One checkbox of difference. And if your surviving spouse is on GIS, a T4A inclusion can also claw back the supplement at 50 cents on the dollar. The same shape we walked in the GIS video. One checkbox at account opening. That is what Margaret's outcome on Path A actually came from. Which raises the practical question. How do you make sure your own TFSA contract has the box ticked the way you want? If you've watched this far, you don't want this happening to your spouse. A six-figure account losing its tax shelter because of one checkbox someone ticked years ago and never thought about again. So here's the practical step. Find your TFSA. Find the beneficiary form. Make sure it says Successor Holder, in writing, signed. At most banks, that's a branch visit and forms in the mail. That's why I moved my own TFSA to WealthSimple. The app walks you through it from your couch. Log in, find the form, pick the option. Under 10 minutes from your phone. There's a referral perk, $25 to you when you fund with $100, and full disclosure, $25 to me. Link and current terms in the description in case WealthSimple changes it. It's not the only option. Your bank branch or any reputable Canadian brokerage will open a TFSA. And the Successor rule works the same at every one. Pick whichever you'll actually log into. But don't leave this video without the form on your to-do list. That's the part that protects your spouse. Now you know the death rule. There is a contribution side rule most people get wrong while they're alive, and it lives in the contrast between the TFSA and the RRSP. If you read the CRA's own contribution room guide, the gap between how those two accounts treat your money is the next 10 minutes worth spending. Same household, same dollars, very different math. That's the next one in the library. If this video named one thing you did not know was costing you, the rest of the library is built the same way. Subscribe so you catch the next one. That form is a contract. Get it right. If you're unsure, an estate lawyer or notary will read it with you. Thanks for watching.